A widow in Vermont named Helen was 73 years old and had just opened her annual notice from the Social Security Administration explaining her 2026 Medicare Part B premium. She had been a registered nurse for 36 years at a hospital in Burlington before she retired, and her late husband Tom had been a state university administrator. Between Tom's pension survivor benefit, her own Social Security, a small pension of her own, and the required minimum distribution from her individual retirement account, Helen's adjusted gross income for 2024 had been $114,000. That number had crossed a threshold she had never thought about. The notice from the Social Security Administration informed her that her Medicare Part B premium for 2026 would not be the standard $185 a month. It would be $259 a month. The income-related monthly adjustment amount, known as the Medicare IRMAA surcharge, was adding $74 additional per month to her premium. On top of that, her Medicare Part D prescription drug surcharge was adding another $14.50 per month. Combined, that was an additional $1,062 per year coming out of her Social Security check before it ever hit her bank account. Helen had also tithed faithfully to her small Methodist church in Burlington for over 40 years. Every December, she wrote a check from her checking account for $9,000 to the church building fund. She itemized that contribution on her Form 1040 along with the standard deduction, except that since the standard deduction had grown so large, her itemized total never quite cleared the threshold, and she received almost no federal tax benefit for the gift. She wrote the check anyway because it was the right thing to do. Her required minimum distribution from her individual retirement account that year was $9,017. She had taken it in November, as she always did, paid federal and state taxes on it, and the gross amount had pushed her adjusted gross income across the IRMAA threshold by fewer than $3,000. $3,000 over the line, roughly $1,062 in additional Medicare premiums for the year, and a charitable contribution of $9,000 she received almost no tax benefit for. Her financial advisor had collected a fee from her investment account every year for 11 years and had never once mentioned a qualified charitable distribution. Her tax preparer at the accounting firm in town had filed her returns every April for 9 years and had never mentioned it either. Same widow, same individual retirement account, same church, same $9,000. One simple change in how the money moved from one account to the other would have saved her over $2,800 in combined federal taxes and Medicare premium surcharges. She had no idea. And the situation Helen was in is the same situation hundreds of thousands of charitable retirees are in right now. Here is what happened. And here is exactly how you make sure it never happens to you. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me explain the rule that Helen's advisor never told her about, because once you understand it, you will see why I consider it the single most underused tax strategy in retirement planning. The qualified charitable distribution, often called a QCD, was made permanent in the federal tax code by the Protecting Americans from Tax Hikes Act of 2015. It works like this. If you are 70 and 1/2 years of age or older, you can instruct the custodian of your traditional individual retirement account to send money directly from your account to a qualifying public charity. The charity receives the funds, you receive nothing. And here is the magic. That distribution is excluded from your gross income on Form 1040. It does not appear on line 4B. It does not increase your adjusted gross income. It does not count as taxable income for federal purposes, It does not count toward the Social Security taxation formula in Internal Revenue Code Section 86, and it does not count toward your Medicare IRMAA calculation. It is invisible to almost every income-driven calculation in the Retirement Tax Code. And under Section 307 of the Secure 2.0 Act of 2022, the annual qualified charitable distribution limit is now indexed for inflation. For 2026, the per-person limit is $108,000. A married couple, each with their own individual retirement account, can give up to $216,000 per year through this strategy. And the qualified charitable distribution counts dollar for dollar against your required minimum distribution for the year. If your required minimum is $9,000 and you direct $9,000 from your individual retirement account to your church through a qualified charitable distribution, your required minimum is satisfied, the church gets the gift, and the entire $9,000 never appears on your tax return. Now, there is one critical mechanical rule, and getting it wrong destroys the entire strategy. The money has to go directly from the individual retirement account custodian to the charity. The custodian writes the check payable to the charity, or wires the funds to the charity, or in some cases issues a check payable to the charity but mails it to you to deliver. What you cannot do is take a distribution into your own checking account, then write a check from your checking account to the charity. The moment that money lands in your bank account, it becomes a taxable distribution to you, full stop, regardless of what you do with it next. The charitable contribution you make from your checking account is then a normal Schedule A itemized deduction, which most retirees no longer get any benefit from because the standard deduction is too large to clear. This is exactly what Helen had been doing for years. She was withdrawing the money to her checking account and writing a check to the church. Mechanically simple. Tax-wise, a disaster. The cure is to call your individual retirement account custodian, request a qualified charitable distribution, and have them send the funds directly. Most major custodians have a one-page form. It takes 10 minutes to complete. The mechanical change is small. The tax savings is substantial. Let me put numbers on this so you understand the stakes. Scenario 1. Helen, the Vermont widow. Adjusted gross income before any change of $114,000. Required minimum distribution of $9,000 taken as a normal distribution. Federal marginal bracket of 22%. Vermont marginal state bracket of 6.75%. Combined federal and state tax on the $9,000 required minimum distribution, roughly $2,588. On top of that, her adjusted gross income was high enough to push her into the second IRMAA tier, costing her approximately $1,062 in additional Medicare premiums for 2026. Now switch to the qualified charitable distribution. Helen calls her individual retirement account custodian and instructs them to send the $9,000 distribution directly to her Methodist church. The church receives the gift on the same day she would have written the check. Her required minimum is satisfied. The $9,000 never appears on her 1040. Her adjusted gross income drops back below the IRMAA threshold for the relevant filing year. 2 years from now, her Medicare Part B and Part D premiums revert to the standard rate. She saves $2,588 in federal and state income taxes this year and $1,062 in Medicare premiums in the IRMAA flow-through year. Total annual savings, $3,650. Same widow, same church, same $9,000. One phone call to her individual retirement account custodian. Scenario 2. A retired postal worker in Iowa named Frank, age 76, widower. Adjusted gross income of $78,000. Required minimum distribution of $14,000. Frank does not give to charity in any organized way. He occasionally drops a 20 in the offering plate at his Lutheran church, but he is not a tither and has no significant charitable giving in his budget. Now here is where it gets important. The qualified charitable distribution only makes sense if you are already giving to charity or if you genuinely want to start. It is not a tax dodge that creates value out of nothing. For Frank, who has no charitable inclination, taking the required minimum distribution as a normal distribution and paying the tax on it is the correct answer. Do not let anyone, including a financial advisor earning a commission on a charitable annuity product, talk you into manufacturing charitable giving you would not otherwise have done just to capture a tax benefit. The strategy is for the genuinely charitable. If that is you, the savings are enormous. If it is not, leave it alone. Scenario 3. A married couple in Pennsylvania, both retired federal employees. Robert is 74, Carol is 72. Combined adjusted gross income of $192,000, including their 2 pensions, 2 Social Security checks, and required minimum distributions from each of their separate individual retirement accounts of $7,500 each. Robert and Carol have given $30,000 per year to their alma mater, a small private university in Pennsylvania, for the past 12 years. They write a check each December from their checking account. They itemize. Because the standard deduction for joint filers in 2026 is roughly $32,000, their $30,000 charitable gift only gets them about $10,000 of net benefit above the standard deduction line. Now run the math under qualified charitable distributions. Robert directs his entire $7,500 required minimum distribution to the university. Carol directs her entire $7,500 required minimum distribution to the university. Both required minimums are satisfied. $15,000 of taxable income disappears from their joint return. They write a check from their checking account for the remaining $15,000 to bring their total gift to $30,000. Their adjusted gross income drops by $15,000. They drop out of the upper IRMAA tier they had been in for years. Their combined federal tax savings on the $15,000 of avoided taxable required minimum is roughly $3,600 at their 24% marginal bracket, plus another $4,600 in IRMAA reduction across both spouses over 2 years. Same alma mater, same $30,000 gift, same year. Roughly $8,200 in combined tax and premium savings. Scenario 4. A retired physician in California named Margaret, age 71. She has a substantial individual retirement account of $2.4 million. Her required minimum at age 71 is roughly $94,000. She has never been particularly charitable, but in her late 60s, she became deeply involved in a local hospital foundation board. She wants to make a meaningful legacy gift, but she also wants to retain some income from the gifted assets during her lifetime. Now here is where it gets critical. Under Section 307 of the Secure 2.0 Act, there is a brand new variation of the qualified charitable distribution that almost nobody uses. It is called the qualified charitable distribution to a split interest entity. Once in your lifetime, a person aged 70 and 1/2 or older can direct up to $54,000 in 2026 from their individual retirement account into a charitable remainder trust or a charitable gift annuity. The contribution counts toward the qualified charitable distribution annual limit of $108,000. The distribution is excluded from gross income. The trust or annuity then pays Margaret a stream of income for the rest of her life, taxed as it is received. At her death, the remaining balance goes to the charity. This is a one-time election per lifetime. It cannot be repeated in future years. Most financial advisors have never heard of this provision because the dollar amounts are modest and the planning complexity is high. For the right donor, it is a remarkable structure that lets you make a charitable gift, secure a lifetime income stream, and exclude the entire principal contribution from your gross income in the year of the gift. Now, here is the part that changes everything. There is a coordination trap inside the qualified charitable distribution rule that catches retirees who are still working at age 70 and one half and still making deductible individual retirement account contributions. Under the Secure Act of 2019, the age cap on traditional individual retirement account contributions was eliminated. Many older workers continue to make deductible contributions to their individual retirement accounts after age 70 and one half. The qualified charitable distribution rule contains an offset provision that says any deductible individual retirement account contribution you make at age 70 and one half or older reduces the amount of qualified charitable distribution you can claim dollar for dollar until the cumulative offset is fully absorbed. So a 72-year-old who deducted $6,000 of individual retirement account contributions over the past 2 years and now wants to direct $10,000 to charity through a qualified charitable distribution will only get $4,000 of qualified charitable distribution treatment. The other $6,000 will be treated as a normal taxable distribution. This trap catches working retirees most often. Run the math before you make a deductible contribution if you also plan to use qualified charitable distributions later. Here is your action checklist, and I want you to take this seriously because your individual retirement account custodian is not going to call you and explain this. Number 1, confirm you are at least 70 and one half years old. The qualified charitable distribution rule applies starting in the year you turn 70 and one half, not the year you reach the required minimum distribution age of 73. The age threshold for qualified charitable distributions and the age threshold for required minimum distributions are different numbers. Many 70-year-olds and 71-year-olds do not realize they are already eligible. Number 2, confirm the charity is a qualifying public charity under Internal Revenue Code Section 170. Most churches, hospitals, universities, and recognized public charities qualify. Donor-advised funds do not qualify. Private foundations do not qualify. Supporting organizations classified as Type 3 non-functionally integrated do not qualify. If you are not sure, ask the charity for written confirmation that they are a qualifying public charity for qualified charitable distribution purposes. Number 3, contact your individual retirement account custodian. Vanguard, Fidelity, Schwab, TD Ameritrade, Pershing, all major custodians have a qualified charitable distribution form. It is typically a one-page form. You provide the charity's name, mailing address, employer identification number, and the dollar amount of the gift. The custodian processes the distribution and either mails the check directly to the charity or mails it to you with a payee line written to the charity. Either method preserves the qualified charitable distribution treatment. What you cannot do is have the check made payable to you. Number 4, give yourself at least 3 weeks of lead time before December 31st. Custodians have year-end processing deadlines, and a request submitted on December 28th may not be honored in the current tax year. November 1st is a safer planning date for year-end gifts. Number 5, ask the custodian to issue a Form 1099-R reflecting the distribution. The qualified charitable distribution will appear on the 1099-R as a normal distribution. It is your responsibility or your tax preparer's responsibility to mark it as a qualified charitable distribution on Form 1040 by writing the letters QCD next to line 4B. Most tax software supports this. If your preparer does not know the procedure, find a new preparer. Number 6, get a written acknowledgement letter from the charity, just as you would for any normal charitable contribution. The Internal Revenue Service requires a contemporaneous written acknowledgement from the charity for any contribution of $250 or more, including qualified charitable distributions. Number 7, if you make deductible individual retirement account contributions after age 70 and one half, run the offset calculation before claiming a qualified charitable distribution. The offset reduces your qualified charitable distribution treatment dollar for dollar. Number 8, if you are charitably inclined and have a substantial individual retirement account, consider directing your entire required minimum distribution as a qualified charitable distribution every year for the rest of your life. The compounding effect of keeping $10,000 or $20,000 per year out of adjusted gross income for 15 or 20 years of retirement is enormous, both in income tax savings and in IRMAA premium reduction. Number 9, if you want a lifetime income stream from a charitable gift, look into the one-time $54,000 qualified charitable distribution to a split interest entity under Section 307 of the Secure 2.0 Act. This is a once-in-a-lifetime election. Use it well with a qualified planner who has actually structured one before. Same widow, same church, same $9,000. Helen in Vermont was paying $2,588 in federal and state income taxes, plus $1,062 in Medicare premium surcharges every year on a gift that should have been completely tax-free under federal law. The cure was a one-page form with her individual retirement account custodian that took 10 minutes to complete. Robert and Carol in Pennsylvania were leaving roughly $8,200 on the table every year on a $30,000 gift to their alma mater. Margaret in California has a once-in-a-lifetime opportunity under Section 307 of the Secure 2.0 Act that her financial advisor does not know exists. The difference between these outcomes is not luck. It is not a loophole. It is Internal Revenue Code Section 408D8, made permanent by the Protecting Americans from Tax Hikes Act of 2015 and expanded under the Secure 2.0 Act of 2022. The rule has been the law for over a decade. The form takes 10 minutes. And the tax preparation industry has somehow managed to leave billions of dollars of qualified charitable distribution capacity unused every single year. This is how charitable retirees die broke. Not from a stock market crash, from writing checks the wrong way out of the wrong account every December for 20 years. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who tithes to a church, gives to a charity, or supports a school every year, send them this video today. It could be worth thousands of dollars to them. And drop me a comment and tell me this. Has anyone, your financial advisor, your tax preparer, or your individual retirement account custodian, ever explained the qualified charitable distribution to you in plain English? Yes or no? I read every single one, and the most common questions become future videos. I will see you in the next.